Alrighty, let's change the direction up a little bit and talk about some volatility. After all, the market is in this boring range currently. We're not going to do any technical analysis for the direction, trend lines, all that kind of stuff. The numbers game for volatility. We're looking at the chart on the right-hand side. That is the most recent one, the last 3 days. That is Monday up to 2 something in the afternoon, and the Friday and Thursday session. And then 3 days a couple of weeks ago. Now, what we are seeing on here is the movements a lot lighter, less volatility. After all, the average moves in this period here was around 2% per hour on the 24-hour cycle. And when we look at, for example, how each line, this one is the difference of top to bottom is only 20 cents, where in here it is $1. That's obviously normal when you have a trending market compared to that of a sideways market. But you can even go further and take a look at the movement sizes. And the first thing I want to look at are just your short, small, up or down swing. And that would be something like this. You have a spot, let's just use the biggest one. And we have a move of 32.50 to about 33.50. That's about a little over $1 when I take a look at that. So about 3%. Now, it's probably comparable to this here. And we have a move of about 33.90 up to about 34.20. That's a little under 30 cents, which is about 0.75%. Big difference, 3 to 1, 4 to 1 ratio. And the pullback, obviously this pullback is going to be bigger than this one percentage-wise because it went from 33.50 down to 33. That's a little over a percent, where the most recent one here went from about 25 cents. That's about 0.6%. So a bigger move because the volatility is that of greater. If we look at the larger size moves, the biggest one on here and the fastest is the move from 33.40 up to 34.50. That's about $1.10, which translates to about 3%. Now, a big move here, I think the biggest one is the move from here to here. That's going from 36.5 to a little over 34. So about 2 1/3. That works out to about 6%. So we're talking a difference of 6% on a big move in comparison to that of about 3%. And there were probably some other big moves, but the difference there is twice as volatile in that degree. Overall, when you look at these charts, these numbers really mean nothing. Because if you were to take a look at this chart, I could put in 31, 31.50, 32, and the charts could very easily trade in that direction. But if you know that something is larger than it's supposed to be, then you get a gauge for how volatile it is. And you get these big moves when something big is going down. And before, it was the margin movements that made the big moves happen. Other ways it can happen is if you have a capitulation washout. Capitulation means large down moves, and I really mean the word large. We have not capitulated long term yet. I think we need to go down to at least 25 or 24, if not even down to 20, 21, to have a large capitulation. And when that happens, a washout bottom would mean big up moves where the short-term time frame would see a move where, say, for example, this is 20, the bottom in here. Let's just assume that this is $20 an ounce silver here. This could be 21, 22, 23, and it goes up from 20 to 23 in a matter of a day. That would be about 12, 13%. That's an example of the big moves. Another one is, say, hypothetically, our currency's backed by nothing, and hypothetically, let's assume that silver has tangible value. Hypothetically, people want to get into it, at least some sort of increase. Let's also assume on a hypothetical level that the COMEX doesn't have what they say and they have stock out bank run sort of problems. Well, in that situation, you're going to see the market probably escalate towards the upside. And maybe silver will be at 46 at the time. And then, boom, it has a big move, a fast move up to, say, 82 in a matter of a week. That would be a move of 32 plus 4 is 36. That would be about 80%. Well, now the volatility is going to be massive. It will be massive to get there to the point where if you have a situation of just your standard higher highs, higher lows, obviously it's going to have bigger levels of movement. So instead of having a 2% up move, 1% back, it's going to be a 5% up move and 2.5% back. That would be the bigger difference, and you'd end up having these pullbacks in volatile days after it happens, where you'd see once again a market going from 38 to 32. That's 20%. That could be foreseen again. The market goes down 20% from 90, then we're back to 72. Those are coming. So either and or it's going to be the capitulation move, or it's going to be the currency crises, currency collapse when it's big in the news and the things are going down, however it's going down. That's when the massive movements will occur. I can't say when, but we've got the bar here set at 2%. Those were the average hourly movements. What I need to see is this really go to 2.5% or higher. And then that's when it's the TSHTF. Yeah, the game over. Take care.